Hello, this is a podcast on how to actually assess and analyze a statement of profit loss and a statement of financial position addressing the current ratio and the quick asset ratio. So I'll be using this one from our student workbook, the IA2 parts, okay, and then looking at what type of accounts affect the current ratio and also the quick asset ratio, concentrating on trends, relationships, and also the issues. So in your planning, you'll receive a number of blue sheets, and within that I'd actually set it out exactly what I've given here. So I would have three highlighters, one for issue, one for relationships, and one for trends. And in essence, we are concentrating on what actually affects the current ratio, quick asset ratio, and what do those ratios actually mean. Now, the current ratio and the quick asset ratio basically look at cash flow and also liquidity. So in any one of your questions, your main idea is what do we need to solve and why the current ratio and the quick ratio may have declined and why we don't have any money and why. So in this case, that is the question that we need to solve. And in saying that, with the relationships part, where is the money coming from? Now, within there, the main important accounts for the quick and asset ratio from the statement of financial position is one is a cash at bank and overdraft. The overdraft basically says that we've got no money in the bank and therefore we need to derive cash flow from other means. And those other means would be the accounts receivable turnover, which is basically how fast our debtors are paying our accounts, and the inventory turnover, which is how quick our stock is actually selling for that financial year. In the current liabilities, accounts payable, and then the ratios that have a relationship with each other, obviously with the net profit ratio, that's looking at the profitability, the accounts receivable turnover, the inventory turnover, and from the profit and loss, our sales, and in particular our sales and credit. Now, when you're actually deriving your answer, make sure you tick off each of these accounts in your response. So make sure you discuss your cash at bank or your overdraft, your accounts receivable, your inventories, your accounts payable, and also talk about the relationships between the net profit ratio, the accounts receivable turnover, and the inventory, and look at and discuss what is happening with our sales. Now, I would have a nice little circle here, and within there I would write what is actually happening with this ratio. So if we go to our question here, there's all the current assets. So there's the accounts receivable, there's the inventories, there's your bank overdraft, there's your accounts payable, and you will be given all of the industry standards here. Okay, so in this question, our current ratio has dropped from 1.7 to 1.2. So what that basically means is we have 1.7 current assets to 1 current liability. Now we need this one to be around 2:1 and above the industry average. And as it's decreasing, I basically said that's a really bad outcome for the business. And as I said, it's below the 2:1 and also the inventory average of 2.15. And so that is basically what we are looking at in terms of an issue. The issue is that our cash flow is declining. So that will be your main heading there. So if I go to my answer, as per the red book, I would put here as a main heading, decline in liquidity borne by reliance on external debt. So borne is basically as a result of. You do not need a conclusion or introduction because this is a report excerpt. So you will need actually headings to get the maximum marks in your genre. And so that basically the movement in the accounts is what is called a trend, and I've highlighted them as a trend. Now, in order to get the maximum marks, you need to identify trends, important trends, and what they are in terms of effects. Okay, in my response, that is green. I didn't have a green highlight at the time, so I put it yellow in this planning document. And then this is the effect of these trends. Of the issue is that the business cannot meet the short-term debts And we can actually see that because accounts payable has actually gone up by 25%. So you need to write down in your question an explanation of the issue and also identification of the trends and effects of that. So if we go to our statement of financial position, we can see that our accounts payable have gone from 80,000 to 100,000 or 25%. Okay, you may get these percentages in the exam. If they don't have them, just talk about how much the actual account has gone up. So that is a very worrying sign for this business. Okay, now in saying that, what are the actual trends or worrying trends from the financial position? And we are getting these here from our important accounts. Okay, so we're going to look at what's happening with our bank, or in this case, a bank overdraft, accounts receivable, and your inventories. And over here, I'll just put your trends and what's happening. So for example, our bank overdraft has gone up by 80%. Our accounts payable, as before, has gone up by 25%, and they are both current liabilities. And then you need to discuss, well, we've got this trend, and what does that actually mean for the business? So the effect of these trends is with reliance on external debt, so in other words, a mortgage or a loan or a bank overdraft to cover our operating expenses, so in other words, our expenses from our statement of profit or loss, or what we incur on a daily basis running this business, and capital expenditure, which is your purchase of your non-current assets. So we can see from our statement of financial position that our non-current assets, so in other words, our vehicles, our land, and our buildings have gone up. So our total assets have gone from 290,000 to 435,000. Okay, and we can see here that it's been a huge reduction, particularly in our land and also our buildings. So when you have such capital expenditure, normally you would use the profits from the business, but we don't have enough profits to cover that. Okay, so we have gone to other external ways in which to actually get this cash. So for example, our bank overdraft has gone up by 16,000. Our mortgage has gone up by an extra 40,000 as well. So we've used that money to purchase these things and to cover our daily expenses in our statement of profit or loss. Okay, so for example, our selling expenses, our administration, and our finance expenses, and our cost of sold. So that's not a good way in which to actually run a business. And then you need to talk about, well, what are the relationships here? And the relationships here are basically a partnership with other key accounts. So for example, our inventory turnover and our accounts receivable turnover are the two main turnovers that generate our cash. So if they aren't improving or above the industry average, that's going to cause a flow-on effect. So that's what the relationship is. Okay, so they're very tight. In other words, these ratios are tied together to generate our cash flow. And our inventory is improved, but still below the industry average. Our accounts receivable turnover is still below the industry average. Okay, and also our sales is mostly made up of credit sales. Okay, so if you look at our statement of profit or loss, you can see here we're only generating $60,000 for the current year worth of cash sales, but we've got 300,000 here sitting in credit. So we need this one to go up more in order to generate cash. Okay, this is obviously a very good outcome. It's gone up by $90,000. However, when we look at the accounts receivable turnover, we are going to determine and analyze whether these credit sales or these accounts receivable are actually paying our accounts on time to generate our money to pay for all our expenses and all our expansion of the business. That will be discussed in another podcast dealing with that ratio specifically. So in that, saying that, this is obviously your plan and how you're going to set out your actual answer. So as I said before, you need to make sure that you tick off all your accounts and your responses, okay, to make sure you've covered your trends, the effect of these trends, identify the issue, explain the issue, and then to identify the relationships with that ratio. So I'm going to go to an example of a response. Now, this one here, will actually be the longest paragraph out of the three. So for liquidity, you'll have three paragraphs dealing with ratios, that being the current and the quick, your accounts receivable, your inventory turnover, and then you'll have a paragraph at the end evaluating whether a scenario based on this question. So always start off with basically what's happening with these ratios. So important terms to actually use is liquidity of the business has shown a decline, so tell me what's actually happened and tell me the exact figures here. So you get your trend marks. Okay. And also with our current ratio, mention the 2:1. That is basically a good safeguard to actually have. So what that basically means is we've got enough current assets, doubled that of current liabilities to meet any short-term debts. Remember to use these keywords here as well. Issue, which basically are signposts to the marker, and also the confirmer, what you have actually identified as being the main issue and to explain that issue. Okay, so the lack of cash flow indicates that the business may not be able to meet short-term debt obligations. In other words, our accounts payable. And then you can combine these two together because essentially they are assessing the same thing or analysing the same accounts. So the quick ratio has decreased from 4.26:1 to 4.42:1, which is below the industry average of 1 and also below our safeguard as well. And so essentially that means that they've only got 42 cents in the dollar, okay, to fund or to pay for our quick liabilities, which means not a lot of money is available for this business. Then we've got these trends. What is the effect of these trends? So to get your maximum mark, identify trends and what's the effect. So the effect is a negative trend, so I would actually tell the marker whether it's a good trend or a bad trend, and it indicates a reliance on external debt to cover operating expenses. So in other words, we're relying on three types of accounts: our bank overdraft or a cash at bank, our loan if we've got one, or a mortgage. And so I've highlighted these ones. Reliance on the bank overdraft is evident as it increased by 16,000, with accounts payable also rising by 25%, which basically means we aren't generating enough money to pay for our bills. That's what accounts payable is on time, and therefore our interest may be charged by those organisations. And as we can see here, our interest has gone up. Now, interest has gone up by $3,000, and that is primarily because of the mortgage doubling. Okay, but essentially, if our accounts payable not being paid on time, we could be charged interest or also a stop on supplies that we need for the business. So a diminished credit reputation can make it difficult for the business to obtain credit. So in other words, getting credit for our inventories, but also applying for an increase in our mortgage, which we may need, or creation of another loan. So then we need to look at relationships. So your question should have a relationship discussion, an explanation of the issue. So we've actually identified the issue through our heading, which is up here. And then you need to discuss trends, which are basically financial figures or numbers, and what the effects of that trend actually is. So to wrap up this paragraph, we're going to look at our relationships, and I would mention whether it's a positive or a negative relationship. In this case, it's negative, and it's being formed due to the lack of liquidity. Okay, so our lack of liquidity has a relationship or a positive or a negative partnership with the following ratios. Inventory and accounts receivable ratios are below the industry average, not providing enough cash flow. So tell me why this is the case. And our capital expenditure or our reliance on external debt is being used to fund our business. Capital expansion, so in other words, buying assets, and also our expenses. You do not need to elaborate any more than that because we'll actually be analysing these two ratios in more detail in the coming paragraphs underneath this. And I would actually provide recommendations as you go. If you are stuck with time, for example, doing and setting this out, you'll actually get marks in your evaluation objective. Okay, so the first thing we need to fix up is making sure that we are not relying on our external debt. So we need to look at the financing strategy. So short-term financing is only used to pay suppliers and to pay for our inventory. So in other words, I'm not using mortgages to do this. In this case, we have been. Now the next recommendation is to sell unproductive assets. So look at your statement of financial position, and we have three main assets: our vehicles, our land, and our buildings. We can assume that these are being used by the business in terms of a place in which they are actually operating on. So they own the land and the buildings that their business is on. We need to look at whether these delivery vehicles are productive or not. And in order to do that, you would be looking at your rate of return on total assets. And if that is going down, then we need to sell unproductive assets. Okay, so mention the assets which you're looking at selling. And with vehicles, for example, we can actually lease them or hire purchase, which basically means that we don't have to purchase them outright, which will improve our cash flow. And the next one is our sales. Now, before we do that, all of these recommendations have come from your workbook. Okay, so we need to increase our sales, okay, which is very important because we're only getting credit sales, not cash sales. And that's probably the main reason why we're in this position of having no money. So provide a recommendation and then how to actually go about doing it. Okay, so your recommendations need to have identification of a strategy and how to actually do it. And how to actually do it, for example, with our assets is leasing, going to leasing or hire purchase rather than purchasing outright. With our sales is reviewing the product mix and look at slow moving or low profit margin items and targeting consumers through better advertising or changing policy. Now this advertising will be looked at in our inventory turnover, and that will form a relationship with those two ratios. So our next podcast will be looking at our accounts receivable turnover, and then I'll create one of these as well. And it'd be strongly recommended that you, in your 15 minutes, you go and do 3 of these, and then that will form your structure for your assessment and writing of it.